Let's get this party started, everyone. My name is Christopher Moore. Like I said, I'm the Chief Marketing Officer of Quiet Light Brokerage. For those of you who don't know, Quiet Light helps entrepreneurs build, buy, and sell their online businesses for 6, 7, or 8 figures. Big part of what we do as a company is educational. We speak at conferences, podcasts, we do AMAs, do webinars like this. And we're always available on phone calls to help founders, entrepreneurs, plan for a successful exit and mostly a successful scale. Today, we're talking about acquisition and growth through acquisition, which is a really great topic in a way that a lot of people can outsmart the startup game. We're very happy to have Walker with us. I'll introduce him in a moment. Quiet Light was founded in 2006. We're entirely entrepreneur-led and entirely entrepreneur-focused. Everyone company-wide has built, bought, or sold their own online substantial businesses, and we're very proud of that. So whenever we're tackling a problem, whether it's from the buy side, the sell side, or the scaling side, we're doing that with a very broad level of knowledge in terms of what it takes and the kind of stressors that you're going to be looking at no matter what side of the deal that you're on. Joining us today for our topic, growth through acquisition, is Walker Deibel, and we're very excited to have him with us. Walker has been with us how long?
A couple of years.
A couple of years, yeah. Walker's a certified M&A advisor. He's 2019 Thought Leader of the Year from the Alliance of M&A Advisors. He's a former SEC licensed broker. He's acquired 7 businesses outright, another 24 as a minority. He's published in Forbes, Entrepreneur Inc., Fastco, Harvard Business Review. His book, Buy Then Build, has been adopted by multiple universities. And as we were just talking about when some of you were coming in, he's got a background in documentary and narrative filmmaking with executive producer credits for films such as Bill Nye the Science Guy, Rolling Paper, Printing the Legend, Finders Keepers, and his latest film, Wrestle, was nominated for the Emmy this year, didn't win, but he was just happy and pleased to be nominated, right?
2 Emmys. But now I know what it's like to be that
2
person.
nominations or 2 wins?
2 nominations, 0 for 2.
Oh, well, you know, your day will come sometime. Anyway, so Walker, I'll give the floor to you. We're really happy to have you. What are we talking about today?
Great. Chris, thank you so much. I assume that you can see my screen?
Yep.
Excellent. Okay, so today we're going to talk about growing through acquisition. And the thing is this topic is very near and dear to my heart. And the thing is that it was a topic that I actually proactively left out of my book, Buy Then Build, simply because, once you hit like 80,000 words and sort of like, multiple sections, at some point the book has to kind of end and you can't just keep going. And so it would have been a little bit of scope creep. And so this sort of builds on the concept of acquisition entrepreneurship, but also just kind of takes it to the next level, right? And so I think that a great way to start is just sort of with my story. And in 2008, I acquired a book printing company. I thought it was a smart move. My prior startup had failed, and I was buying an existing company with decades of profitable revenue, okay, customers and existing infrastructure. At the time, it was doing just over 8 million in annual revenue. But something else happened in 2008. Does anyone remember? The Great Recession caused the economy to tighten, unemployment to skyrocket, and consumers to finally let go of print. Bookstores and newspapers went out of business left and right. And for a 4-year period, 36 printing companies a week went bankrupt. If you think about it, that's almost 1 every single working hour, okay? But since we started 2008 with like 28,000 printing companies, this huge number of bankruptcies really only actually represented about 2% of the printing companies out there. But trust me when I say this was an absolutely stressful time. Okay. What was going on was, Amazon released the Kindle at this time, and this was a company that needed headlines, right? And was really promoting the sort of, electronic alternative of reading and ebooks. And the thing is that today we understand an Amazon attack, when we see it. But at the time, we didn't quite understand what was going on yet. And just to add insult to injury, this bozo comes out with, a game-changing device right at the sort of apex of our disaster. Okay, and so it wasn't though until 2013 that The Onion came out and officially called print dead, right? And despite the satire of this, newspaper, it was really well aligned with the perception at the time, right? And so, but the thing is that this hilarious and terrifying article actually ended with the comment, "Oh, on second thought, the world will probably forget about print pretty soon, actually," right? And so, this is what was going on in the world. But the thing is that all the headlines and all the noise and all of the disaster among all of this, it was actually really hard to see the truth of the situation, all right? The truth is that the overall book sales weren't actually down all that much, okay? So what does that change there? I mean, like the entire industry goes from like $16.5 billion to like $16.3 billion, okay? There was still $16 billion in annual book sales, okay? And this is not even counting like non-direct-to-consumer, like internal corporate manuals and catalogs and other things that we sort of printed, right? And so with most printing companies struggling, for those that could see the truth, it actually was the greatest potential for growth in the printing industry of all time, okay? So why were so many printers struggling with this? And, forgive the fact that most printing companies aren't actually book specific, which gave us a considerable advantage at that time. But while traditional publishers, okay, maintained a fairly consistent hold, there was this tremendous growth in the self-publishing category, okay? So this actually resulted in 27% year-over-year growth trend from 2005 to 2008, and then increasing from there, right? Like new ISBNs were simply on a tear, okay? The industry was changing, and the recession coupled with the preceding adoption of the internet was accelerating what was possible for authors and how people shopped, right? So do any of us remember when Amazon just sold books, right? So it turned out that bookstores were not going out of business because people weren't buying books. It's because it was the first Amazon attack, right? Consumers were buying online and getting books shipped directly to them, right? So new authors could go around publishing houses, write books, and get them in the hands of readers. Publishers could also, tackle the long tail, right? In terms of like titles that were out of print. So in short, I had over 100 publishing companies as customers who could benefit from this changing landscape. If I was able to supply digital book printing to them, I could retain or grow their revenues while increasing the profitability of my own company, okay? So, first of all, I promise you that there was more than 4 people in my company at the time. They're all on the other side of the camera. But the point is I tore down some walls and put bought some digital book printing machines. I bought a low run perfect binder, right? And within the first 24 months of this photo, the revenue from digital book printing made up a quarter of our entire company. Okay, I was able to leverage the decades of knowledge that I acquired when I bought the company, as well as the entire customer base, and then use it for a platform for innovation, right? So I want to stare at this graph for a minute. This is really, really important. So this is the innovator's dilemma from Clayton Christensen, the Harvard professor. And this is a really critical graph to understanding new technologies and how things move through time. Okay, so the 2 dotted lines going horizontal across the screen, I want you to imagine this is time changing. Okay, if you're below the low dotted line, then that means that the quality of your product is it's not good enough for people to actually buy it, right? It's not good enough for product market fit at all. If you're above the top line, the red line, that means that all companies manufacturing that same product, the product is essentially the same. There's no longer any big differentiators, and it moves into commodity material, right? And so what happens is that this upper line on the left, sustaining technologies, they slowly move up over the line, and this is the big product market fit. This is the way that things kind of occur, and then time passes, and suddenly some new technology bumps up from the bottom, okay? And all the big guys kind of laugh at it and say like, oh, that's cute. Look at that new little technology. Like we have nothing to worry about, nothing to worry about. Well, as it improves in quality and as more and more people adopt it because it answers, a bigger piece of the pie, the technology then shifts over time to that new thing. So I understood this graph, and that's why I knew that the way to go was to, innovate by bringing in digital book printing, right? So I'm a pretty smart cookie, and things were really working out for me. Not really. What happened was, after the initial growth spurt, everything suddenly declined. It suddenly hit a ceiling, right? And the reason for that was because although I had introduced this new way of operating and was helping publishing companies increase their working capital and increase their profits and increase the number of titles that they could sell, the thing was that our go-to-market strategy still lacked a direct-to-consumer sort of platform that was going to feed the sort of new digital publishers that were emerging, okay? So I needed to expand to kind of like a direct-to-consumer sort of model, okay? And I looked at this and I thought, okay, there's a lot here. Like what really needs to happen is I need to build this whole like SaaS infrastructure, right? Everything from getting quotes online and having the quotes done electronically to like ripping different files, having them go on different presses and creating barcodes and all the rest of it. And so, I did a lot of research and I talked with, IT people that could help me build this. I talked with online marketing people that could help me, build this out and launch it, despite being a crowded space. And ultimately the business plan that I put together really called for a $1 million investment in creating this whole thing. Okay. Now, I didn't have $1 million. So that's sort of number one. But number two was it sort of occurred to me like, what would I actually get if I did have $1 million and I put $1 million into this thing? What would I get? And I realized I'd probably get the infrastructure that I'm wanting to build. I'd probably get some branding. But what I wouldn't get was guaranteed revenue, guaranteed customers, or guaranteed earnings, which means that this is looking a lot like a startup, right? And we all know what happens to startups, right? So 90% of them fail, okay? Only 10% of startups really ever make it, all right? And so I could not fail. But something started occurring to me, like as I started to become, a CEO and a business owner, and I started to get involved with the Entrepreneurs Organization and really understand the landscape of what it meant to be an entrepreneur. Okay, I started to have this realization. Okay, and that's that only 4% of companies in the United States ever exceed $1 million in annual revenue. So, think about that. Like, out of all the startups that fail and the 10% that make it, out of that 10%, 96% of them never even exceed $1 million in annual revenue. Okay, so like when I was an MBA student, like $1 million in revenue was like such a small company, I sort of like ignored it, right? But I started to understand the exceptional nature of companies that were significantly smaller than what I had in my head. Okay, so the thing is I was able to sort of lower my bar in terms of what actually produced a successful company. All right, and Mark, our fearless founder at Quiet Light, just pinged me privately and said, "That's great, Walker, but what does all of this challenge at Corley have to do with acquisitions, right?" And the point here is that by acquiring an existing company, I was able to obtain existing cash flow, existing customers and revenue, talented and knowledgeable staff. I'm talking about like craftsmanship, okay? And an increased ability to service those customers through new products throughout a changing marketplace. Okay, so my first startup had failed completely, and I saw a tremendous opportunity to buy an existing company, and I bought this one, and then another half dozen others, and I ultimately wrote about that, right? And so the thing is that I knew at this time, because the printing landscape was so dire, that I could actually acquire printing companies for around like 2 times their earnings, okay? And moreover, use debt in addition to do that. And so the thing was think about that $1 million mark that I was going to have to invest in the SaaS platform. What I figured out was if I spent $1 million, first of all, I could finance 90% of it and buy over $400,000 in earnings. Okay. And so the thing is that by using debt, you can actually acquire one of these largest 4% of companies really in the world for less than $100,000, for about 100,000 or less. Okay, so let's pretend you are comfortable with debt. Okay, which is a big if. You need to get comfortable with it and understand your own comfort level. But the thing is that because of these initiatives coming out by the Small Business Administration, okay, check out this graph. So basically 100% is going to be the transaction value of the company you acquire. All right, so for this example, let's say that you're doing a $1 million transaction, okay? So 10% of that is going to, I'm gonna max out my debt in this example. 10% of that is at $100,000. So I'm gonna put 100,000 down and I'm gonna borrow 900,000, okay? By year 7, okay, assuming I can grow the business at 10% a year, by year 7, I've turned that $100,000 investment into $1 million in equity buildup, okay? And by year 10, I've got over what is that? About $2.25 million, okay? No debt at that point in time. And so I took that $100,000 and turned it into 2.2 million just in that time. So let's actually jump in and look at an example here. So, here's a company over an 11-year period, maybe 12-year period, because I got year 0. It's doing revenue of 1.4 million, and the seller's discretionary earnings is a little over 200,000. If you don't know what SDE is, don't worry about it right now. Like, just think to yourself, like, this is the amount of cash flow that an owner gets benefit of, okay, when they acquire it. So I'm going to put in $94,000 to acquire this business. I'm going to grow it at 10% over 10 years, 11 years there. I'm going to sell it at the same exact multiple in this example that I bought it for, okay? And so I get the benefit of all of the SDE minus the principal and interest payments. And then I get the exit value, okay? And so my total return, it's actually in the wrong column there. I see that. It should be under the SDE column. But my total return is over 5.7 million off of $94,000. The ROI on this stuff is absolutely unparalleled compared to any other asset class, okay? Now, if you already own a company, like I imagine everyone on this webinar does, the thing is that you don't even need the additional cash flow. You already have a foundation, right? And so the thing is that you can take all of the seller discretionary earnings, not just say 45% in this example, and have the whole debt paid off in this example by the end of year 3, okay? Because you don't need the additional cash flow. And so you want to use all of it for equity buildup as soon as possible, all right? So you start to understand the impact of the additional cash flow that's coming, right? Now, buying a company is crazy. Like, who would possibly do that, right? Well, look at this margin of safety. So we've talked about startups, okay? Like, 10% kind of make it, and out of that 10%, like, 96% of them, stay relatively small. Venture capital, though, I mean, this is like the gold ring, right? We're all going to run out and like change the world with our big ideas, and hey man, we're venture capital back, no problem. Turns out 75% of VC-backed firms go to zero. And let's see, if there's a book out there called, it's escaped me right now, I'm so sorry, but it's the actual returns that venture capital companies are getting are less and less as time goes on. They're having smaller and smaller exits. In fact, that might be it. It might be called smaller exits. But so acquisition entrepreneurship has for the last numerous decades, has had a under 2% default rate, okay? These are companies that were acquired with an SBA loan, okay? And when I say under 2%, it usually hangs out between like 1.3 and 1.7%, okay? It's about 1.5%, just they default. Bad decision, poor management, whatever it might be, okay? Now, the thing is that this 98% is a little misleading, because I don't want you to think that like 98% of these people totally succeed. What it means is that 98% don't fail, okay? And the new research out of Stanford shows us that about a third of these people are getting truly exceptional results. And another third is getting good results. And then the sort of other third is getting, kind of treading water, okay results kind of a thing, right? So, but if it comes down to like truly getting yourself in a bind, hey, here are your options, all right? So let's back up a minute though and talk about what drives the value of your company today, okay? So there's really these 6 things that kind of make up the value of your organization. All right. Now, 4 of these things, for those of you familiar with Quiet Light, you'll notice them immediately as the 4 pillars of value that we talk about over and over and over again. It's business risk, transferability, documentation, growth opportunities. If you want to really dig into that, there's an amazing blog post about all of those things. I'm going to talk about the other 2, okay? These 2 are the fundamental drivers of value in any company, okay? Growth and earnings. Earnings in that, what are the earnings, right? Are they $5, 5,000, 50,000, 5 million, 50 million? Like, what are they, okay? Because the amount of your earnings puts you in completely different ballparks, okay? It tells me, are we playing little league, or are we, what, the analogy would be like publicly traded company, I guess, right? And so it sort of speaks to what the overall value is of that company. And then historical growth is the other one. So, every single prospectus I've ever seen says something along the lines of past performance is not an indicator of future results. Well, not exactly true when it comes to business valuation, right? So of course there's going to be a forecast, but the biggest indicator of forecast is past performance. That's why we buy companies, okay? And so let's go back to this, let's say that you've got $1 million in earnings this year. That is so great. That's a great number. Now it's especially great if you had $500,000 last year, okay? And what this tells me as a buyer is, hey man, I better buy this company really quickly, because if I wait too long, I'm going to have to pay, instead of say 4 million, that would be a 4x of $1 million in this example. I might have to pay, a 4x or a 5x or a 6x off of, 2 million, right? So that the amount of the cash flow is increasing over time, and the value of the company is increasing the longer I wait, okay? On the other hand, if last year, instead of $500,000 and you're going the right direction, what if $1 million in earnings is not great if you made 2 million last year, right? This is sort of the opposite. It tells me that the value of this company, the forecast is not so good. And so I need to be really careful and manage my risk as a buyer very well, right? So what I want to do is I want you to imagine your company, okay? And then we're going to grow it by acquiring another company, all right? And simply by doing that, you get the added revenue growth that we just talked about, which then also gives you that additional earnings growth, right? Now, you can keep going and add another one, but something really interesting happens here. If you look at this, when you started, your business was maybe valued around a 2 to 3 times earnings. But once you get up to, a much larger size, you're moving out of this ballpark and into the next ballpark, okay? And so this is called multiple expansion. And let's look at what this multiple expansion really looks like. So let's say I was making $500,000 in earnings. I'm going to multiply it by 2.75. Please do not read too much into these numbers. I'm just putting a stick in the ground for an example, okay? So this is about $1.4 million. Who wants 1.4 million? I do. I want that number, okay? That's a lot. I want that money. Now, if I grow it though, from $500,000 to 2 million in earnings, which is not a small task, we all understand that. But what happens is that the value of the company starts to increase at an exponential rate. Okay, so instead of the multiple effectively doubles here, and you go from like a 1 million to a $12 million exit. Okay, so this is the multiple expansion that we're talking about. Okay, now, does anyone know who this is? Okay, this is John Malone of TCI, Telecommunications Inc. John Malone was born in 1941, okay? He was an adolescent entrepreneur. He would like buy, refurbish, and sell like used radios, right? I mean, he was athletic and like ultimately went to Yale, great American boy, right? Where, he got his undergrad in economics and electrical engineering, and then he went on to get his master's and PhD in operations research, also at Yale. So smart dude. After that, he took a job at Bell Labs, which was kind of a highly prestigious research arm of AT&T at the time, right? After extensive research and financial modeling, he came to a very unorthodox conclusion for the time. He suggested that AT&T should increase debt level aggressively and reduce its equity base via share repurchases. This suggestion by John was graciously received and promptly ignored, okay? Because it is crazy. No one was doing that at this time. So Malone, like any good Yale boy, went on to McKinsey Consulting, okay, and spent a few years sort of fine-tuning his opinions of what made an attractive industry before ultimately deciding to commit his career to cable television. He did this for three real reasons, okay? It had three characteristics that he really admired, all right? Recurring revenue. It's a capital-intensive business, which worked as a tax shield. And also there was an immense industry tailwind at this time, okay? So he ultimately jumped ship and joined TCI in 1973 as its CEO at 32 years old, okay? Seemed like a good decision at the time, all right? Just like when I bought Corley. But they were immediately blindsided by intense regulation, and the cable stocks cooled significantly. So TCI, who had debt equal to 17 times its annual revenue, was in a particularly precarious position. In order to like battle bankruptcy, he developed a frugal culture at the company that focused on ultimately two things. One, grow the subscriber base almost at all costs, and number two, keep the banks at bay, okay, because they were after him, right? So despite the massive debt burden that he had to navigate, by 1982, he decided that the key to future success would be through leveraging size, okay? So his strategy entailed minimizing pre-tax earnings so he could fund internal growth and acquisitions through his own cash flow, all right? So imagine for a moment, you're gonna buy company A here. Let's break this down. Okay, you're gonna buy it for X million dollars. Any slide I show you, if it's not in enough money to interest you, just add zeros until it gets interesting, right? Okay, but so we're gonna buy this company for X million. We're gonna take the cash injection from our pre-tax revenue of our own company, pre-tax net income of our own company, and that's gonna be the cash injection. You can think about that as like down payment, okay? Then we're gonna use leverage for this other piece. Now the thing is the entire X million purchase price gets depreciated and amortized over time, okay? In this example, like at Quiet Light, we do a lot of internet businesses, which are a lot of goodwill, right? There's not a lot of hard assets, and so goodwill tends to be depreciated over a 10-year time frame, okay? And so you get these long time frames of the entire thing that you depreciated. Now, keep in mind, depreciation and amortization is not a real cash expense. There's no real money coming out of your operating expenses. Instead, you're depreciating the money that you borrowed back here for this acquisition, and then you're using that depreciation as a tax shield to block your taxable revenue, which then gives you more capital to go do further cash injections, okay? You will have an interest expense, which is real money coming out of pocket, but you're basically paying a small percentage of all of that capital that you got access to. It's just not totally free, right? Today, SBA loans are borrowing at around like 4%, okay? So the thing is that like, because this is so awesome, you might not want to just buy company A. You might want to buy A, B, C, D, E, F, G, H, right? And the thing is it doesn't look like this. It doesn't look like a bunch of bars next to itself, okay? It really looks like this, okay? You acquire a company, you plan to grow it over time, both through equity buildup and through organic growth. And you buy another one, have the same plan, buy another one, have the same plan. And when you eliminate all of these different colors on this graph, what it really looks like is this. This is the revenue that we all want as entrepreneurs, okay? And so coming back to John Malone for a minute, the thing is like, he had to come up with words. No one understood what he was doing. And so, I'm sure everyone who's a business owner on this webinar knows this word, earnings before interest, taxes, depreciation, amortization. Okay, everyone thought John Malone was nuts. Earnings per share was the unit of measure in the public marketplaces at that time. And so he struggled and he fought with the analysts and tried to explain what he was doing. And finally, he invented the word EBITDA. And the word EBITDA was all about John Malone expressing to the public markets how he was gaining a strategic advantage by creating a tax shield and then using the internal additional income of acquisitions to do more acquisitions, okay? If you invested $1 in TCI the day that John Malone became CEO and sold that share of stock, whatever it was, the day he retired, it would be worth $933. That's huge value, okay? John did over Mr. Malone did over 100 acquisitions during his time frame. I mean, this was his entire business strategy, and a lot of the language that we use today is all around growing through acquisition because of the power of. I feel like I just sound like Darth Vader, Chris. Sorry, power, but it's the fastest way to growing your company. Period. The first company I bought was doing $8 million in revenue. Okay. After I sold that, between 2014 and 2016, I acquired 5 companies in that 2.5-year time frame and went from $0 to $8.2 million in 30 months. Okay. The first of those 5 that I bought, I sold 4.5 years later and got a compounded annual growth rate of 52%. It's kind of ridiculous. My next slide is something that I don't actually share, but I'm realizing it's in this slide deck. Okay. My average cash infusion on these acquisitions that I did was $140,000 for an average revenue of about $2 million. Okay. Now I want you to know that I've been able to do this in, a distribution. I bought a distribution company. I bought a promotional items company. I bought a custom built manufacturing company. I've bought a powder coating finishing company, and I've done this in online businesses and specifically e-commerce. Okay. So the question is Walker, this is great, but like when does this make sense, and how do I know it's for me, and all the rest of it? I want to talk for a minute about life cycle of industry. All right. So this is something that we're all really probably familiar with on this call. So you've got this sort of phase in the beginning where the technology is sort of getting worked out. Like, is this going to happen or not? Right. Then you have this huge growth period. And that's where venture capital lives. Like, they all make all these bets at the beginning of the growth curve, trying to ride that sort of land grab up, right? And then you get into maturity, where this is the way things are. This is how we operate. And then usually there's a decline in something as a new technology kind of comes in. So maturity is where roll-ups and leverage buyouts, like the entire private equity industry, kind of exists, right? And the thing is acquisition entrepreneurship kind of works right here. It sort of works both at mature and both at the beginning of the growth phase, right? And specifically in online, I actually think that we're seeing a decline in retail, and we're starting to see the growth in online retail. And so we've got that going for us right now as that tech change is kind of occurring. And so right here is sort of a platform opportunity. And this is where companies get really inexpensive, right? And so why the heck would you buy a company right here? It's because the people that buy right here understand that it's not always a decline. It's usually a great opportunity for someone willing to reinvest capital and take that next growth curve. In other words, Jim Collins wrote a great book called How the Mighty Fall. And the subtitle is and why the others stick in and make it, or something. What we've learned is that it's the incumbents of the industry that is getting disrupted that more often than not succeed in maintaining market share, and the ones that can actually make it are the ones that dominate the industry, okay, in the long run. So I want to kind of give you an example. So buying right here is kind of the same as buying right here, okay? It's the same thing. You just have to know what you're looking at. I want to give you an example of a company that just did this, okay? So I guess not just, but Facebook is by any means not a declining, okay, company, right? But the thing is it was falling out of popularity with its target market. As all of us sort of aged and more people got on Facebook, Facebook sort of became unpopular with the kids, right? Like, it's the old people's platform, right? Insta was the new thing. So they bought Insta. And, we're seeing a lot in the news right now about TikTok and it's always like, what's the next thing? And so big companies acquire. They're acquisitive because this is such a great way to grow. It's available to you as well, okay? It's not just for the big guys. Amazon bought a grocery store, for crying out loud, okay? And this is one that expanded their footprint, expanded their revenues, and expanded their product lines. Like, I don't know about you, but Now I can get liquor in like a couple hours by ordering from Amazon, which is great because of their acquisition through Whole Foods. Okay, so they're taking their own core competencies and applying it to new markets. And the thing is that there's a confluence happening right now that has never before happened in history. And this is critical to understand and why this is such a huge opportunity. There's an estimated $10 trillion in baby boomer businesses that need to change hands. This is business value, okay? This is about 45% of the entire US economy that needs to switch to the next generation. Imagine for a minute that it doesn't transfer. What the heck will happen? I mean, we'll have to rebuild this entire thing, okay? And there is so much infrastructure there that we as online entrepreneurs get to leverage. In other words, that's the second thing, is that this sort of proliferation of online marketing and the online business. And so we've got this huge infrastructure that needs to transfer to people that can change it and take it to the next level, okay? Or, you know, by just sort of like tried and true, long-standing existing businesses. The third is that cash has never before been this easy to access, period. In 2018, January 1st, 2018, this is the day the SBA came out and said, listen, we know that it's easy to get a cash flow based loan for a $50 million acquisition. It's impossible to get one on a sub $5 million acquisition. And a lot of these like sort of Main Street businesses, you know, that Main Street businesses throw in like a $1.5 million online based business that fall into Main Street, okay? All these businesses, they don't have like substantial assets and we need to help them transfer, okay? So I think, no one's ever said this, but I think that what the SBA is thinking about is like, we need to transfer these businesses over, or there's a bigger problem happening. So we've got this confluence happening right now of these three things all coming together. And online-based businesses, in my opinion, and one of the reasons why I joined Quietlight, is there's a huge advantage for online-based businesses. There's really three core competencies, right? So it's like advertising, paid, organic, social, supply chain management. Okay, so keeping inventory, you know, obviously it's for an e-commerce business, and then, you know, customer service, just like servicing the customers. The point is you can scale these. Once you have these core competencies, you can almost just add them on top of each other without adding additional overhead, or with very, very minimal overhead compared to other industries. Okay, and so the thing is I'm challenging you to not just be an entrepreneur, but also to think like an investor. And in the middle, what you get is this sort of acquisition entrepreneurship, and not only a great way to start, but also, you know, to grow. Chris, before I jump into this last section, did you want to say something?
Sorry, I was muted there for a second. Yeah, so I just want to invite everyone. We've already got a couple questions rolling in. If you have a question, feel free to raise your hand. Type a question into the Q&A window. You can also put it in the chat window. We'll be sure to ask all that we have time to get to. So don't forget to put those questions in. We'll have a little bit of time for that at the end. And on with the show, Walker.
I hope we have time. Talking is like my favorite thing. Okay, so how do I get started?
Didn't notice. I had no clue on what you were doing there.
So I just love this stuff. I'm like Zeppelin. I can just go all night, right? So anyway, the point is you know, there's a buy then build acquisition process that I put together. This is very overly simplified. Like this is very hard. Okay, this is entrepreneurship. It's not like, oh, I'm gonna buy something and forget it. Like, we all know that. We're entrepreneurs. We know how it goes, right? But like, just at an overly simplified level, these are the 5 steps, right? You understand the business model, make a commitment, prepare, you know, go start your search, go through the acquisition, and then build, right? And, you know, if you really want to unpack all of these things, of course, I'd be remiss if I didn't mention that I happen to write the book on it. So please go out and check it out if you so choose. This is the growth through acquisition funnel. And I bring this up because in Buy Then Build, I've got the prep funnel for acquisition entrepreneurship. And as I started to look at growing through acquisition, I realized that a lot of the same concepts translate, okay? But they're slightly different because you already have something that you're bringing to the table that is not you, it's a company, it's an infrastructure, it's an organization to some level, okay? So the first thing you need to figure out is, what is your core competency? This is the thing that you are bringing to the table, and the very thing that you need to leverage the most in terms of identifying the opportunity that you're going to move forward on. Okay. Look at the industry trends. What is the direction of where things are going, and what do I not have? What could I acquire that would be the infrastructure, that I need, right? Like, what's that area where things are kind of growing? Okay. Strategic direction. You want to use those industry trends to come up with your strategic vision, okay? And where it is that you want to go. Here I said strategic direction because you cannot go acquire your vision. That's up to you. That's what you do, okay? But you know where that direction is, and then you can sort of acquire things along the way so that the sum of its parts becomes your vision, okay? You identify the desired infrastructure that you want. This is the thing that I challenge all startup entrepreneurs on all the time. It's like, what is that infrastructure that you're trying to build by raising all this capital, okay? Because you can probably acquire it cheaper than you can build it from scratch, okay? And it comes with so many benefits that we've already talked about. I want you to think about the size, only because, if you want to do a $1 million or less transaction, it's a totally different deal structure and probably even approach than if you're going to run out and do like a 25 or larger kind of acquisition. They're totally different things, right? So although the process is similar, you need to understand the size so that you can understand what it is. And lastly, it's just sort of the geography or defining the kind of like limiters and the things that are going to lead to where your bullseye is. Then you come up with this target statement, and that's the thing that you use as your motto to go out and try to find that thing. Okay. So how do we get started? There's two ways, okay, to find deal flow, all right? The first is broker outreach, all right? So let's talk about that. Business brokerage is a completely unregulated industry, okay? So you can literally have someone working on Wall Street who, goes rogue and opens up their own M&A firm, and you can have someone who, was fired as a used car salesperson because they couldn't, cut the mustard, who becomes a business broker. Both of those people could be talking to a seller that is potentially the company that you are wanting to buy, okay? So there's all of these titles, and there's sort of some history behind each one, which we're not going to get into here. But I want you to understand that all of these business broker, M&A advisor, investment banker, intermediary, they all mean the same thing, okay? Not only investment bankers on Wall Street like sort of take companies public, but they all mean the same thing. Okay, so this is where CEOs go when they want to try to figure out, how do I sell my business? How do I put together an exit strategy? Do I sell now? Do I sell later? Like, when should I do it? There's 5,000 of these firms out there, and so they're really easy to identify. And the thing is that speaking for myself, I will work with some sellers for a year or more before they're ready to sell. And there's a lot of mental preparedness that goes into it, and just a lifestyle decision. And so ultimately, if you want deal flow, the fastest way to get it is outreach to brokers and get on their mailing lists, okay? There's some drawbacks, of course. You've got limited inventory. So, if you want a, FBA skincare company, I've got one right now. I'll sell it to you. If you want a coffee content site, I don't have that. I don't think we have that at Quiet Light right now. So if you're looking for something very specific, it's hard to find that deal right then, right? So they also represent sellers, and that's kind of key to understand. The sellers hire the business broker to be a part of the deal and kind of run the process. And so depending on the broker you're working with, they don't always have your interests in mind, right? And obviously there's a lot of buyer competition. So Quiet Light, the last launching I did, we got 4 full price offers within 10 days. And so, if you're not quite ready to move and you're not clear, you can lose out to competition. Then there's this sort of like proprietary deal flow, okay? So you've got, this is sort of like the outreach thing where you're reaching out to other people. The concept being, I really want to be that bird in hand when that seller decides to sell. And what I'm going to tell you is that I ran a process similar to this at Corley for about 2.5 to 3 years. And what I learned was that a lot of these people, they really want 20 times earnings as a valuation. And it's because they deserve it. Because as entrepreneurs, we bleed and we sweat and we put everything we've got into a business, and like, we don't make money for 2 years and then all of a sudden it works. Okay. And so we know that it's worth like 20 times earnings, right? And so there's this learning curve that they have to go through as a seller. So they don't understand the private capital markets. They don't understand the valuations. And that's why going to brokers actually fast forwards a lot. You also know that the seller is ready. Whereas when in proprietary outreach, sellers aren't really ready. And it's incredibly inefficient. Okay. So running these processes over and over, I've learned that you kiss a lot of frogs, kind of a thing, right? And off-market deals happen, but they're tough also without a coordinator, which is a broker. Listen, we're here with Quiet Light. I've got to tell you that I spent 10 years acquiring companies, and during that time, I've been licensed by the SEC. I'm a certified M&A advisor, and I'm familiar with public companies. Solidly middle market. I was recruited heavily to be like $50 to $100 million M&A advisor. And the thing is I bought a business once, and the broker said, Walker, you like really know what you're doing. And I was like, yeah, I do. And he was like, hey, he decided that his succession plan was to sell me his whole brokerage. And he tried to sell me his whole brokerage. And that's when I called Mark Doust at Quiet Light. And I said, listen, Mark, if I'm ever, like, I love deals and I feel like I've gotten really good at it. And if I'm ever going to work as a broker, I will only do it at Quiet Light. And the reason for that is that I've seen the whole landscape. I've looked at thousands of deals from all kinds of profiles, and the single best ones always come from Quiet Light. And I think that there's a little difference that makes a big difference. And Quiet Light just kind of has that special sauce for me. And so I called Mark and came on in 2018. And the thing is that if you are looking for deal flow, or if you are looking for an education, Quiet Light business summaries, in my experience, are the single best way to get up to speed quickly, because you can read a prospectus and get a great sense of is this a fit for me or not? And you have the clarity to move quickly. I also recently created something called the Acquisition Lab. Okay. This was an extension of Buy Then Build. Essentially, I've had people, ask me like, will you help me like kind of try and find a business and help me buy it? And I'm like, no, that's crazy. I can't charge you enough for that. That's crazy. Right. And so I started this sort of like, instruction curriculum it's 8 weeks long with an ongoing search forum, sort of like group coaching, tools, community. It's great. If doing something like that is interesting to you, I'm just going to put that out on the table. You can go to acquisitionlab.com and learn more and apply if that's of interest. There's 3 big mistakes. Chris, how are you doing on time? Okay, I'm going to bring this home. 3 biggest mistakes all first-time buyers make. Ready? Here we go. Number 1, they overweigh the importance of why is this person selling, okay? I want you to understand, first of all, that everyone, the first time that they start considering buying a business, they think to themselves, okay, the seller's obviously trying to like dodge a bullet here, like pass a hot potato. Look, 1% of the human population are scumbags, okay? It's possible that that's what's going to happen, all right? And you need to look at it and consider that in diligence. But you also need to understand that when you start a business or buy a business way back here and then own it, run it for a while, you create value. And the day comes where, I grew this business from like, nothing to, pick a number, 2 million in revenue. Okay. And I've sort of done my thing. I don't really know what to do for like or I don't want to sort of like do the next reinvestment to take it to the next level, because I'm really good at starting up. So having an exit is part of the entrepreneurial journey. It's what everyone on this call wants one day. Okay. I promise you, everybody wants it, because you make 50% of the financial benefit of even being a business owner on the day that you sell. It's just part of the process, and people want to sell because you get an exit. Okay. Number 2, these buyers, they lack clarity. Now, 9 out of 10 of people who start looking for a business to buy never actually pull the trigger, ever. And I think that one of the biggest reasons for that is clarity. We actually solve that for you on this call, because now you have the GTA funnel, right? So now you know what you're looking for. right? But the thing is like you need to understand what it is that you're looking for so that when it shows up, you know to move because you know that's the business that you want, that's the infrastructure you're after, and you're ready to go. Okay. And the third is most people lack urgency. Okay. People don't understand the acquisition entrepreneurship business model. They don't know what they're trying to accomplish, and they don't work with a deadline. And so if you say to yourself, I'm going to grow through acquisition, and I'm going to have goals, and my first acquisition is going to be done in 6 months. Okay. That changes how you act. Okay. You're not going to sit back like a startup investor and be like, okay, pitch me, right? You understand what you're trying to achieve, and you're moving with a sense of urgency. Okay. Those are the little things that made the big difference. So just to bring the whole story around, what happened at Corley, right? What happened was I ultimately found a company that was a perfect fit. I had 50,000 square feet in St. Louis. This one had 5,000 in Chicago, as well as another place in Kentucky. And they were essentially doing one-off book printing, which was like the gold ring. There was 3 companies that could possibly do it. This company was one of them. They solved all the things that I was trying to figure out. I spent 4 months, remember proprietary deal flow? Once I got him, I spent 4 months trying to convince him to sell, selling him on the dream, selling him on like what we could do, da-da-da. One day he sat down and said, Walker, I love your vision. We've got to do it. I just want to change one thing. And doing the things that led to the outcome I wanted ended up leading to my first exit, which was awesome. Okay. The thing is he wanted to buy me. He saw the vision and wanted to do it. And so, sometimes growing through acquisition can also set the stage for your own exit. Again, sort of 3 takeaways from today. Go sign up at Quiet Light to be a buyer. Consider the acquisition lab if you want to take it to the next level, or simply pick up a copy of Buy Then Build and read to your heart's content. What I want to say is like, if you want to sell, or you want to consider selling, or you're wondering if it's the right time, or want to do some exit planning, feel free to email me at walker@quietlightbrokerage.com. Okay. If you're looking for buy-side training and coaching, email me at walker@buythenbuild.com. I've got 5 different companies right now. And so I need your email to go into my right inbox. So Chris, that's what I got. Sliding into home plate here on time.
So we do have a lot of questions. Thanks everyone for sending those in. We're going to try to get to as many of these as we can. And we may end up going a little bit over if that's okay with people.
I'll go over. I mean, the presentation's done. Like, I'm happy to spend some time answering questions
So, I mean, I think, one thing to me that I would really love to know is like, you're talking about 10% down for an SBA loan. So when is the right time if someone has a business now? I mean, I assume that a lot of us, I've got a couple of different side hustles that I'm working on. When is the right time to exit, your current business in order to leverage your next business?
It's such a great question, Chris. I'm going to change your question just a little bit. I think that if your question is when do I exit my business so that I can grow my next business? The answer is pretty clear. Your desire is to grow your next business, so you should sell, right? Right. But I think your question is more like, should I exit or should I grow through acquisition, right? I mean, that's maybe the question. And I guess that what I would say is that the number one mistake that sellers make is just waiting too long, right? In other words, buyers are smart. Buyers are you and me and everyone on this call, okay? We understand business and we know what it takes to run a company. And we know when all of the meat has been taken off of the bone, right? And so the thing is like, you want to sell while your business is still growing and while your forecast is still strong. And if you sort of wait until it flatlines, right, or even starts to decline, you've simply waited too long if your goal is to maximize exit value. The bigger question is, when are you ready, right? So it's a qualitative human decision. Most of the time, sellers come to me because as entrepreneurs, we all have shiny object syndrome, right? And they say like, oh my God, I've got this idea. I'm going to start working on it. Like, oh my gosh, okay, I've started working on it. But hold on, I've got this company I built over here and now it's worth $2.5 million. And I need to just kind of sell it to focus on this because I don't really know what the next thing to do is over here, right? That's when you sell. But if you look at that first business and you say, I want to keep growing, I'm just kind of trying to figure out how do I, instead of getting like a $1 million exit, how do I get like a $12 million exit? And hopefully the material we went through today gave you one option for doing that.
Super. Great. So next question is from Owen. How do you value a company when there's only 1 to 2 years of earnings to go off of? Like, what's your valuation process for that? And like, are you able to get an accurate valuation for that company?
Okay, so we only have 24 months of
data?
data?
24 months of data.
Okay. That's in the online world, that's going to be long enough. Okay. In the offline world, it's, people tend to want a little bit more than that. The thing is how do you value, okay. How do you value a company? Is kind of a whole different webinar. There's a lot of there's a lot of resources at Quiet Light around that. I think the thing is if the question is, can we properly value a company with 24 months of earnings? The answer that I'm going to give is yes. If it's less than 24 months, we at Quiet Light take the position of it's too young. We can't really consider it at that time. Does that answer the question, Chris?
I think so. I think getting under 2 years is a little bit risky for us, and at the same time, it's like, a business is worth what a buyer is willing to pay for it, and there's too much risk involved in buying something under 24 months.
So what I would say to that is two things. One, there's no statistical data to properly value a company less than 24 months old. Okay, so there's no good way to value it. So it's a situation like that where what you said, I also believe, which is it's worth what someone will pay for it. I actually think that the value of a business is not what someone would pay for it. Okay, right? Like you can say that, and it sounds really nice, but the thing is like I actually think that there is a exact correct valuation that we can get to based on market conditions, based on a lot of the attributes of the business, and also understanding that there's a deviation off of that number. So there's a value range that is appropriate for every company out there, right? And just because you can find, let's just say, one sucker to way overpay doesn't mean that company should be valued at that, because it's not the valuation. We just found a sucker, right? If you can't find someone to pay in that valuation range, it doesn't mean that the company isn't worth it. It just means that you're not working with Quiet Light.
All right, perfect. Our next series of questions, I'm just going to combine a few because we're getting a lot of questions that surround SBA loans.
Okay.
Specifically, how do you get around the personal guarantees for SBA loans, or is there like a way to do that? Or is there an alternative to SBA loans that doesn't require signing a personal guarantee? And how can you see if a business that you're looking to acquire is SBA eligible? So there's a few questions in there.
Okay.
Eligibility and then personal guarantees.
Okay. So if it's an off-market deal and there's no broker involved, okay, you're not going to know if the company is SBA eligible or not. You're going to want a company that, believe it or not, hasn't grown too fast and has at least 2 full calendar years of tax returns. Okay. Not grow too fast because they need the multi-year average to sort of be able to cover the debt service coverage ratio. Without getting into, they need 2 years ago to also cover the debt they're going to extend you today, kind of a thing. And if it grows too fast, you have problems. At Quiet Light, we pre-qualify all of our listings, and so you will know ahead of time if it's pre-qualified or not. The other big thing is that if it's not U.S.-based entity, that it's not going to be SBA eligible. In terms of the personal guarantee, this is the goal of the decade, I think, right? And so the thing is like, in order to get financing, you need either cash, and so you don't, you can use your own cash or use it as collateral, or a personal guarantee. There is no way in the world to get around an SBA loan without a personal guarantee. It has not happened once, because the way the SBA works is they are not actually extending the loan. They are acting as your collateral to the bank for, it's either 75 or 80% of what they lend to you, okay? And so because they're lending you that money, they say to the bank, we'll back, Susan, but Susan, hey, we need a personal guarantee. And that's what the government gets in order to back the bank. And they'll say, listen, we'll take the risk on Susan. She's good for it. Even if she bombs, we'll get our money. Don't worry, we're the government. But you can't do that. So other forms of financing, here's the thing. There is a lot of clickbait out there today. As acquisition entrepreneurship has gained in popularity, there's a lot of people out there kind of preaching like, no money down, blah, 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 use a heavy seller note, all this kind of stuff. Look, if you're going to use a heavy seller note, okay, that's fine. Most times you got to come up with like 45% of the cash anyway. And then you can use, and this only really works in deals under $1 million. Okay. And so the other profile is companies that are mature or declining and are so unattractively untransferable that you can get people to sort of work with you off market. Okay. But if you want to buy a good business, okay, and you want a margin of safety and a greater success rate, you're simply not going to get a seller, in my opinion, to cover that kind of a thing. In terms of other financing activities out there, in my experience, I've had friends of mine who, they've got, 20, 25 million sitting in cash at a bank, and they've got, a couple successful businesses with no debt. Okay. And if that's your profile, then, getting a bank loan without a personal guarantee is in the cards for you. You can make that happen. Okay. But if you're someone who, like me, when I started out, just like, I've got nothing to lose, or, even now I've got something to lose, but like not enough that the bank's going to be like, oh, it's okay, Walker, it's cool. So I have not, in 12 years of doing this, really 18 that I've been looking, found a way to get financing without a personal guarantee. You can raise capital. There's something called a search fund, where the search fund will basically raise capital, and they'll take on the debt. But you don't want that if you already own your own business. And if you do that in the normal search fund model, you as the entrepreneur will really only end up with between 10 and maybe 25% of the company. So it works a lot like a private equity model, where the operator sort of gets 20% of the company, but the equity firm gets 80. And so the thing is like, there's different ways to skin the cat, but to me, they've always seemed unattractive. Like, I want to own the company. I want 100% of the stock, or at least 80%. And I want to have full control, and I want all the benefits of the upside. And I've been in rooms with startup entrepreneurs that have used other people's money, and they're like, okay, guys, we're on our last burn, and we need to like start looking for jobs instead of like giving the money back to the investors. And so the thing is I always challenge entrepreneurs. If this is the opportunity that you can do, then at some point you've got to put yourself on the line if you want all the equity. Either that, or go raise a bunch of capital so that you can buy it with other people's money.
Great. Could you give me, no, we've got lots of questions. I'm reading through them right now. Lots of really good ones. Could you just give me the biggest one or two challenges you see when buying and transforming a company? I mean, is there a common one or two?
Yeah. It's cash. And you need to be geographically flexible with a search fund. That's exactly right. A lot of search funds, a lot of the companies they buy they're sort of like statistically significant to the geographies that where people live. But they're usually nationwide. And if you are geographically limited at the beginning of your search, you will be geographically unlimited by month 18 when you're 23, when your funding is about to run out. So a lot of times someone from Boston will end up moving to rural Georgia because that's where the opportunity is. Sorry, Chris, what was the question?
Sorry. a common challenge you see? You
Yes,
said
yes,
fast
yes.
when
So, yep.
buying and transforming.
Yeah. The challenge, and the reason I call this acquisition entrepreneurship, is because the challenge is always working capital. Okay, it's always, do I have enough money to, like, listen, I want to be very clear. When I buy a company, I continue to live off ramen noodles for the first couple of years. I don't start like being like, oh yeah, on paper this looks great, let me start pulling cash out. You need to build security. You need to build cash. A lot of times you need to reinvest in the thing that will take you to the next level without without shooting yourself in the foot. Okay, like you need to watch working capital very closely. Get that debt paid down. Build up equity. Build up that margin of safety. Build cash for a rainy day, troubled times, because we know that they'll come eventually. And a lot of times, if you're going to buy a company in order to innovate it, it demands some kind of additional capital expenditure or investment of some kind that you're going to pay for out of the cash flow of the business. So it truly becomes like a startup, like, because you're going to invest in that new infrastructure, but you're going to use it by with the cash flow of the company. So I think it's a really dangerous scenario to, like, buy a new company, max out your leverage, and then, plan to take out a 6-figure salary and reinvest in the future and try to build up cash. Like, you can't do all of the things. And so I always sacrifice myself and eat on ramen noodles until I'm in a place of safety.
Great. Super. Moving right along, which value creation lever is most likely to impact EV positively, weighing risks and opportunities? Add-ons, holistic digitalization, bottom line optimization, top line business development.
Okay, so the number one thing that will increase the enterprise value of a company is transferability, okay? And I'm ignoring growth and earnings because I'm hoping I hit that home. Transferability. So I had the pleasure of interviewing a guy named John Brown on 2 different occasions. And he wrote, he created like a certificate for brokers that's like, exit planning. There's 2 of them, so I'm so sorry, I forget which one it is, but it's like the Exit Planning Institute. And he's got a certification, and you go through, and I read his books, and I've done all of his stuff. I didn't sit for the exam or anything, but I interviewed him twice. And at the end of the second interview, I said, so basically exit planning all comes down to transferability. And he said, yeah, no, that's really it. That's really it, right? And the point is that, like, if I have a company that, like, let me give you an extreme example. It's a little confidential, so let me give you a different example. Oh, okay, here's one. There's a company in I'm not gonna say where, that I tried to buy, and it turned out that it was off-market deal, but the owner, the entrepreneur, had a advanced degree in solar engineering. Okay, and it was, you can guess, a solar-based company. And what I found out was that he was like the only salesperson of the company. All right, and so in other words, whoever was going to buy this company needed to be someone willing to buy a company, someone who was an entrepreneur or a leader to some extent, and number 3, had an advanced degree in solar engineering and had a sales skill. Okay, this is a tremendously difficult company to transfer to, like, anybody, right? It's like a fraction of a percent of the human world. And so the thing is when you go to market, okay, you want to be able to go to market to the most people possible. And so by making yourself obsolete with low workloads, no special knowledge, frankly, if in online, we just have this beautiful advantage of most of the time not having to be geographically limited to one place, right? So, I recently talked with a company that I'm advising on exit planning a couple years ago, and they had a facility here in St. Louis, and everyone came to work every day. And I was like, guys, it's a couple of partners. I said, guys, tell me what actually needs to happen here, right? And so over the following year, they implemented everyone going remote, and over time have, as there's been rollover in the company, they've hired people from all over the country, and now their entire company is virtual. So it's not even limited to like a St. Louis, someone within a 150-mile radius of St. Louis or someone willing to move here. You can literally sell it to anyone in the world because there's no geographic limitation. Transferability is the key.
Awesome. Terrific. Okay, moving right along. Speaking of transferability and transition, are there any suggestions for ensuring a smooth transition in terms of HR or bringing on new management, ensuring that employees are engaged, setting incentives, employee shares, anything like that?
I'm going to assume this is from the buy side, Chris, or is it from the sell side?
I'm guessing from the buy side.
Okay. From the buy side, I think I want to. Okay, sorry, I'm getting stuck in the chat. I'm just going to close my chat because I can't read and answer questions.
Yeah, just answer the question. I'm working it for you, buddy.
Okay, thank you. So here's the thing. Going into it, what you want as a buyer is you want comfort knowing that the seller is going to be there for the proper amount of training and transition. Okay. And so in offline businesses, there's almost like a standard that's like, hey, seller, you're coming to work for the next 90 days after closing. Okay. In the online world, that's like totally extreme. Like if someone's working the 4-hour work week, like, if they spend 8 hours with you, they don't even know what to talk about after that, right? Like there's just not a lot coming back to that transferability, right? So what I do is I really want them to kind of commit to, and I want to set their mind to like, hey, you're going to be involved with me for 90 days. Okay. Then right after closing, I spend the first week to 10 days downloading their brain as fast as I can and actually like doing the activities and all the rest of it. Right. And then what happens is every time I've done this, even when I sold the company, the guy brought me in as vice president of sales and marketing, and I was number 2 in the organization, and I lasted 32 days. Like, I can't work for other people anymore. It's just like, can't do it. But the point is like something happens to a seller 30 days after they've sold their business. It's no longer their concern. They no longer get the benefits. They no longer have the risks. They no longer have the authority. So they have no control. They have no benefit. They have no, and they start to experience a freedom or a weight lifted off of them in a way that they're like, I don't care anymore. And you can maintain it for about 30 days and then everyone's brain just falls off a cliff. So I just try to download their brain as fast as possible. I work them pretty hard for the first 2 to 3 weeks. And then I work them pretty softly through to the end of the month. And then there's usually this point of mutual, where I'm like, okay, I don't want the seller around anymore. And they want nothing to do with the business anymore. Right. So I remember this one company I bought, the spouse of the seller, I think it was day 31, deleted their business email account off of their cell phone so that like there was no more connection. And I'm like, yeah, it's that quick. It happens that fast. So you get a good 30 days and then feel free to call them after or whatever if you got a question. Everyone's nice and wanting to help, but like you're not going to get much after 30 days, in my opinion.
Sure. Would you recommend acquiring?
Sorry, you want to get
acquiring companies in the same industry or vertical?
What's the first part?
Would you recommend acquiring companies in the same industry?
Yes. In the same vertical, no. In other words, look, I did like horizontal transactions. Okay, so I bought in multiple different industries at the same time, and my thought was that I believed that I could scale acquisition entrepreneurship in a way that would look like kind of a small private equity firm or maybe my own little family office, right? What I found was that every time my phone rang, every time I got a text or an email or anything, it was like a completely different problem in a completely different industry with a completely different set of people and a completely different financial statements and situation and completely different geographic location. So it's sort of like my head had to turn a lot. And the thing is that it's not like I brought on a bunch of back office staff to run it. I really tried to do it all myself. And you lose the benefits of momentum if you do that, okay? Now, a vertical acquisition would be like, I'm a publishing company, so I'm going to buy a printing company that supplies us, and I'm going to buy a paper company, a paper merchant that supplies the printing company, that supplies the publishing company, and I'm going to go all the way down and buy a paper mill, so that I'll own the paper mill, the paper merchant, the printing company, and the publishing company. And I'll be able to capture all of the value through the whole vertical, okay? To me, it's very rare that actually makes sense. You really want to question, why are you doing it? And really push yourself and challenge yourself to understand, how is this going to make sense every step of the way? At times it does, okay? But focusing in the same industry is where you start to get the momentum and the benefits, and you start to turn that flywheel. It's how you get from, a $1 million exit to a 12 or $20 million exit, okay? That's the thing. And the more you can make it make sense, the better. So because we're all, online businesses, quite like, you can define one company as, hey, we do e-commerce, and we've got one person doing customer service for all 6 of our brands, and we've got one person doing, ads for all of our brands. That makes sense. It's unified. If you have like 6 different e-commerce companies and they're all in different things, one's doing, shoe sole replacement, and one's doing pet food, and one's doing whatever, it can become a little hard to package as one, right? It starts to be like, wait, this isn't one company. This is sort of like 6 pieces kind of all thrown into the same legal entity. And it can lose some of its juice there. So you need to just make sure that you're syncing the companies together, or that if you've got a company in like, pet food, then like anything pet related is fair game, because you can start to redefine your business as, we do, we're pet e-commerce, for example, as opposed to, I've got these 6 different things and we're an e-commerce company. They can both make sense. You just have to be really careful.
Great. Time for a few more here, I think. How many companies do you have to look at when you're buying? Do you look at like 5 or 6 before you make an offer? You do more? I'm guessing I know the answer to this question, but it's up for you to.
So this is funny, because this is the question I ask in the acquisition lab to really get people thinking. So I kind of don't want to reveal my thing, but what I'd say is this. Let me say it like this. Let's pretend that you read, buy, then build. You go through the prep funnel, you build your buyer profile, you come up with your target statement, you get really clear on what you're doing, okay? And I work with you, and I know, Chris, that this is the company that you need to buy. I hand it to you, okay? If it's the first business summary you've ever looked at, the odds of you buying this company are 0, okay? It's just not gonna happen. So you have to understand the industry and get kind of comfortable with it. And frankly, that's also why I always suggest just going to Quiet Light and signing up as a buyer, right? Because once you're on the list, you get notified of all the businesses. And even if it's just the academic exercise of saying, okay, look, the first 100 companies I look at, I'm not going to buy. Like, I'm just committing to not buying. I'm just committing to some number, okay? Whether that be 10 or 30 or 100, like whatever it is. The thing is like, you just need to look at deals before you can actually then hit this sort of like inflection point where you're actually ready to pull a trigger on something, right? Because there's a lot of prep that goes through just to make you not a tire kicker, right? And it takes a certain leap of faith to buy a company, because you're taking on a lot of risk when you do it. And so I really encourage the academic exercise of looking at a lot. And of course, there's not going to be a right answer for everybody. And also, what does looking at a business mean? Like, Is it just deals across my desk? Is it deals that I've requested information on? Is it sellers that I've talked to or even visited the company if it's offline? At what point, do we start to say I'm looking at it? And so it's going to be like a big number, smaller number as you get down your own sort of deal funnel, right? And I think that the best way to reduce and speed up the amount of companies you need to look at is simply that's why I built the prep funnel, right? That's why I built the growth through acquisition funnel, is because so many people fail because they walk into the restaurant, so to speak, not knowing. They're like, oh, I was told I should be hungry, but I have no idea if I like, barbecue, Mexican, Italian. I don't know if I'm a vegetarian. Like, I have no idea, like who I am, what I bring to the table, or what I want to eat for lunch. And then you hand them a menu, and they don't know what to do with it, right? And then they, if there's that one business that's on the menu, they might not be ready to receive it. And so you need to just kind of look at deals and then kind of watch the market for a while. And I think that's how you get comfortable. And you won't, the clearer you get, the less time you're going to waste.
Okay. I think we kind of
we got time for like one more. Do we have
Do you want to look through these and see which one you think is like through the Q&A deal? I mean, you will know what you feel most will be most important.
Oh, Chuck's making a good comment on here, which is some people think of earnings as a earnings multiple on months. If you consider a valuation off of a multiple of monthly earnings, that is going to be very squarely in the sub-$1 million acquisition market. It actually took its foothold in the very early days of online business transactions, when there wasn't any multi-year valuations being done, but the entire private market industry runs off of annual earnings. I don't know that I have the same questions that you do. Oh, thoughts on purchasing a franchise. That's interesting. Would you recommend expand business models from, let's say, pet food e-commerce to pet ebooks to pet education videos to pet food affiliate? Yeah, if you can define it, Tim, as, we do ebooks, videos, affiliate. Yeah, I mean, that's all online businesses in the pet industry. That has a very clear mission, right? And it jives very easily. So I wouldn't absolutely. Thoughts on purchasing a franchise? Yeah. So and becoming a franchisee. So yes, there is a guy. There are franchise consultants out there that will sort of help you think through franchises. Here's the thing with franchises. I think that if you buy a franchise, there's always going to be a limit to the size it can be because it's a franchise. And so let's just make one up, like Subway, okay? Let's just say that the average Subway makes $1 million a year, okay? So I'm gonna buy a Subway, great. Now I'm going to make $1 million a year in revenue, and I can't grow it from 1 to 1.5 million because that's outside of the market available to me in that one location. So now I need to open multiple locations, right? I sort of have this daydream that the guy that lives on the big house on Wydown here in St. Louis, who no one knows, owns like 6 Subways. I think it's a very fine way to make money and sort of, play Monopoly. You just want to be really careful because the franchise, the franchisor is the one that owns which territories actually get sold off and if you get another one. And take Subway, for example, I think they have to pay like, I don't know, so I shouldn't say a number, but it's something like 6 to 8% or something like that back to the franchisor every month of their revenue. And so the question becomes over time, like at the beginning, it's probably a good investment on marketing, but 12 years later, what are they actually doing? Everyone knows you're there. So like, so you lose some control, you get improved startup success, But for me, it's kind of capped. Like you can only do so much with one franchise, and that's how I feel about it. And I do think it's a good option for people that are operations focused, that kind of want their own thing, and just sort of you just need to understand the business model and how it's different from buying a non-franchise model.
I'm right. I'm answering a question in type. You got any more in there you want to hit up?
What is the broader, this is David, what is the broader target for acquisition? Maybe not a coffee content site, but what would a niche online publisher target? Can you give an example of their broader acquisition target statement? Oh, interesting. So sure. I mean, it could be like, okay, so instead of saying I'm looking for a specific, content site in doing this thing, pets or coffee or whatever, it's going to be, I'm just looking for content sites. I think that is a great common thread for a business. Okay, like I think you can say I'm doing content sites. We do SEO and new content generation, and that's our core competency, and that's what we do. And as a result, we buy content sites doing whatever we want. Okay, and then we've got standard operating procedures to build them. And so your target statement might be something like, I'm looking for content sites with SDE in the 100 $200 to $400,000 annual level, right? Something like that. Like the target statements for companies that are online, you basically get to remove a lot of those limiters, because you don't want the brokers in this example deciding for you whether a certain business will fit in your target or not. So in other words, if you were to add some kind of limiter like with no bad backlinks, right? Or no PBMs, feeding into these sites. Well, now you're telling the broker, like, you go figure out if it has that or not, and you want that control, because you want to be able to see all content sites in your price range and kind of go from there. Yeah, Lee says 6 to 8% in royalty fees, and you need to be a multi-unit owner. Yeah, okay, so that's on the Subway thing there. Good. Thank you, Brent. Closing on your first business October 27th. I could have not done it without Buy Then Build. Woo! Love it. Okay, all Brent, please email me and I'd like to interview you for the acquisition lab so that we can get your story. All today, would you buy offline and transform or go online directly? This is a great question, Tim. So I believe, Chris, this is the last question. It's 2:30 Central. I think I'm even late. But Tim, I love this question. I believe that the answer to the best business models today exist in marrying old economy business models and new economy business models. So, you look at Apple, okay? They make cell phones, right? They're a phone company, but they aren't. They're a software company, right? You look at Tesla, they're a car company. You look at Amazon and we think it's like a website, but it's not. It's a series of warehouses. For me, like the ultimate opportunity right now is not just being able to acquire the baby boomer businesses as they're retiring, but also being able to marry new economy innovations to them. And what I did with Corley Printing was I bought a manufacturing facility, and then I ultimately tried to reach out into the digital and online infrastructures that were making the difference. What I did with EDC was I bought a distribution company, and I used the cash flow to build out a proprietary e-commerce storefront that we then rolled out to over 100 customers and got them to start using us. Like we became like a private Amazon, right? But these businesses are very hard to scale. Probably the hardest part of managing a business, God forgive me for saying this, is employees. Because every time there's another person, there's complexity, right? And every time someone is sick or can't show up or quits or whatever, it's like, okay, like that's not what I was doing today. And you have to kind of work with it. So as you go offline, there's a lot of like hang your hat on kind of economics at play that can make you feel really good. The thing is that scaling them becomes difficult, right? And the thing is that when they were at a time where product market fit, where they achieved product market fit, the internet wasn't around. And so most of these businesses don't have, effective online marketing at play. And so I think that like, if what you bring to the table is like, hey, guys, I'm just making this up. I'm an MBA, so with leadership experience or management experience to some degree, and I'm comfortable in a facility, and I also happen to have like, a software expertise or online marketing expertise to some degree. I think that there's just a tremendous value that can be gained from that combination. So having one foot in both of those economies is the big secret, I think, for the next 10 years.
Awesome. Walker, thank you so much. This has been a really excellent, informative 90 minutes. I really appreciate all of your thought and attention to detail on this. Thanks to everyone who attended and all your questions. If they want to get in touch with you, Walker, can you give us those, can you share your screen again and give us those by the acquisition lab?
Yeah, it's really easy. Walker at Quiet Light Brokerage.
Great. Walker Quiet Light Brokerage. You can check out Buy It and Build on Amazon. You can do the acquisition lab at acquisitionlab.com. You can contact us at quietlightbrokerage.com. If you want to look at any of those listings, look at a business prospectus like Walker was talking about, you just click on any one of those listings, fill out the one-time NDA. That's good for a year. You can look at any listings on quietlightbrokerage.com. That's a really good way to start looking at what kind of businesses you want to require and what a good business looks like as opposed to a kind of crummy business. If you want to, reach out to any of us with any more questions, please feel free to do so. You can reach out to Walker at quietlightbrokerage.com. I'm Christopher at quietlightbrokerage.com. You can reach out to inquiries at quietlightbrokerage.com. You can, if you have a site you'd like to sell, you can do that at quietlightbrokerage.com/sell. Or if you want to look at those listings,
or you can just write Walker at quietlightbrokerage.com.
All right, terrific. Well, thank you everyone for participating in this webinar today. We'll be doing more content like this throughout the rest of the year and coming in 2021 when things all return to normal, right? Thanks a lot for your time. Have a great day. Say thank you, Walker.
Oh man, no, thanks so much. Thanks so much, guys. I'm sorry I went over. I love the engagement. Looking forward to next time.
All right, thanks, guys.